Hello and welcome to this video on the accounting cycle. In this video, we're going to learn how financial statements are prepared, and with this knowledge, it will improve your ability to analyze business decisions and how those decisions are going to impact on the firm's profitability, liquidity, and going concern. In this video, we're going to provide a brief overview of the process that accountants go through in preparing financial statements, and we're going to have the focus on someone who needs to use financial accounting information. So we're not going to go through every single step that the accountants go through. We're going to provide a broad overview, the big picture of how financial statements are created. Good luck. So let's learn about the accounting cycle. If we want to know how financial statements are prepared, we need to learn the accounting cycle. On the left here, we've got a manufacturing firm that's producing some smoke and producing some products. And if we want to create the financial statements for this business, we have to record every transaction the business engages in. The accountants will then tally up all these transactions, and eventually some financial statements will be produced. So let's have a look at all these steps in the accounting cycle and learn how financial statements are created. So let's look at the first step in the accounting cycle. Every time a business buys or sells something, it needs to record that transaction. And this is called a journal entry. Just like writing a diary or writing a journal of all the things you've done in a day, a business has to do the same. They have to record every transaction that they've had. And accrual accounting requires that for every transaction, at least 2 accounts are affected. This is called double entry accounting, and it's the basis of all our financial statements. So let's go through this process with some examples. So first of all, we've got transaction 1 here. A company starts its operations by selling shares for $250,000 in cash to some investors. How do we journalize or record this transaction? The business has received $250,000 from their investors, so the cash account, which is on the balance sheet, will increase by $250,000. So this transaction can be recorded in a worksheet like the one we've got here. In this worksheet, I've listed the balance sheet accounts and some profit and loss accounts. Not all accounts that a business might have, but just some of the main ones we'll see. And when the business has sold their shares and raised cash, we can see the asset cash has increased by $250,000, and the equity account called share capital has also increased by $250,000. So this is step 1 of the accounting cycle. Every transaction gets recorded, and following double entry accounting, we have at least 2 accounts that are affected by a single transaction. Next up, our business decides to buy a building. And in buying a building, they spend $100,000 in cash. So to record this entry, the building account, which is an asset, increases by $100,000. And the cash account, which is an asset, decreases by $100,000. We need to record this on our worksheet. And we see in the asset section, cash has decreased by $100,000. And the building account has increased by $100,000. Next, the business pays an employee $1,500 for work they have completed. We've paid the employee, so our cash account, which is an asset, decreases by $1,500. And we're going to record a wages expense. So on our profit and loss statement, the wages expense will also increase by $1,500. This will be displayed on our worksheet. Assets of cash decreases by $1,500, and over here on the profit and loss statement, we'll have a wages expense of $1,500. So we go back to this accounting cycle. What we've just done with those 3 transactions is record journal entries. Now here, accountants use some slightly more formal language. They use terminology like debits and credits. We're not going to cover that in this particular video. We're going to keep things a little bit more general. We're going to think about which accounts went up, which accounts went down, and where they belong on the different financial statements. So next up, the next step is post to the ledger. Posting to the ledger is really simple. Every account has a running total, and that's called a ledger or a T account. So for the 3 examples we've looked at so far, the cash account, the business started with 0 cash. We then raised $250,000 cash from investors, so our cash went up $250,000. We then spent $100,000 cash buying a building, and $1,500 cash paying an employee. So at the end of the period, our ending cash balance or closing cash balance will be $148,500. For every account the business has, they will have a T account or a ledger account, an opening balance, any additions, minus off any decreases to get you an ending balance. Step 3 is to create a trial balance. The trial balance is quite simple. We're going to list every account that the business has. For our example here, our business has a cash, building, share capital, and wages expense account. And we list the total or closing balance from each of those accounts, T account or ledger. So we have 4 accounts here and we have each of their balances. Now I've put some numbers on the left and some on the right. If you're an accountant or you actually want to be an accountant, we need to learn the rules of debits and credits, and the effects will be on the left or the right. But for our purposes, we know each account and the ending balance. And we can see the trial balance balances, the column on the left and right equal each other. We are now up to step 4 of the accounting cycle, which is adjusting entries. Transactions aren't always recorded as they happen. Something significant has to happen, such as an invoice or cash moving, before a transaction record is actually made. And so sometimes when we're preparing our financial statements at the end of the month or the end of the quarter or year, we need to do what's called adjusting entries to make sure those financial statements actually reflect all the important information of the business. So here's an example of a simple adjusting entry. At the end of the month, our employee has completed another week of work. We want to produce our financial statements because it's the end of the month, but we have not actually paid cash to the employee yet. But the employee has done a week of work. So what we need to do is we need to record the fact we have incurred a wages expense, and we need to record the fact that our employee is owed $1,500. So the wages account is an expense and it increases by $1,500. And to record the fact that we still owe the employee, we create a wages payable account, which is a liability on the balance sheet, and that's got a $1,500 balance as well. We can put this in our worksheet. So here we've got our wages owed adjusting entry, wages payable increased by $1,500, and wages expense increased by another $1,500. We then create what's called an adjusted trial balance. It's the same as the trial balance with the addition of the adjusting entries we've done. So we just did an adjusting entry that increased our wages expense by $1,500. So it now totals $3,000. And we also created a $1,500 wages payable liability. So our adjusted trial balance now has different balances and they still balance out. So now we can actually create the financial statements. From the adjusted trial balance, we look for any revenues. And in this business, we haven't yet sold anything, so our revenues are 0. But we do have expenses. We've got $3,000 of wages expenses. So our overall net profit, or in this case is a loss, is $3,000 loss or negative $3,000 net profit. Net profit is revenues minus expenses, and this net profit figure will then go into our next financial statement, which is called the Statement of Changes in Equity. So here we have the Statement of Changes in Equity, and it's got 2 main sections for us. The first section here is changes in the share capital account. At the start of the year, the business had no equity. It didn't exist. Then during the year, our first transaction was we raised $250,000 of equity by selling shares. So we had a share sale of $250,000. Then finally, we'd calculate our ending balance, 0 starting balance, plus $250,000 of share sales gives us an ending balance of $250,000 in share capital. We then also need to look at the retained earnings balance. At the start of the year, we had no retained earnings. There were no previous profits because the business didn't exist. During the year, we recorded that $3,000 loss. So we then calculate our ending retained earnings. The starting balance of 0, we then had a $3,000 loss. We'll end up with a retained earnings balance of negative $3,000. This retained earnings balance and the ending share capital balance will both go onto the balance sheet. So here's our balance sheet. It lists our assets, it lists our liabilities, and it lists our equity. The equity balances are taken straight from that statement of shareholders' equity, where the assets and the liabilities come straight from our adjusted balance sheet. From our adjusted trial balance. Whenever we create a balance sheet, we need to make sure the assets equals liabilities plus equity. That means it has to balance out. And here we can see our total assets are $248,500. And when we add up our liabilities and equity, it also totals $248,500. The final statement is the cash flow statement. And here we've just taken the numbers in a very simple way from the other financial statements. We've got our cash flow from operations, investing, and financing activities. The opening cash comes from last year's balance sheet. Because there was no balance sheet last year, the business didn't exist, our opening cash balance was 0. Our ending cash balance comes straight from the balance sheet we just created, and the difference in these two balances is our change in cash for the year. And that's also going to add up to the total of cash flow from operations, cash flow from investing activities, and cash flow from financing activities. So in conclusion, we've just looked at the accounting cycle. Following the accounting cycle allows us to prepare financial statements. It starts with recording every transaction that a business has. We've used a simple worksheet, but in practice, businesses will have very sophisticated accounting software. Every transaction gets tallied up and we have ledger accounts for each account. The ledger account keeps a running total of the balances in every account. The ending or closing balances from those ledger accounts flow into the trial balance. Then at the end of the period, we may need to engage in some adjusting entries. After those adjusting entries are conducted, we create an adjusted trial balance. And from there, the balances go into the different financial statements. Key thing to remember is the profit and loss statement is prepared first. The net profit figure then goes into calculating the retained earnings balance in the statement of changes in equity. The statement of changes in equity allows us to also calculate the ending share capital account. And from there, we can create our balance sheet using the share capital and retained earnings balances from the statement of changes in equity. Finally, we can create the cash flow statement, leading us to completing all 4 of the financial statements. I encourage you to practice this process. Please go through the candy store example that's available and record all those transactions and see if you can create the financial statements yourself. Good luck with it. Thank you.